Hello, this is Brian Overby. I am the author of the Options Playbook, and I will be your host for about the next 25 minutes here on Options Guide TV. Today's date is Monday, January 8th. The markets are, they're kind of battling what's going on with Boeing. Boeing, with all their issues with their planes, is driving the Dow lower, so hurting the industrials just in general. But we are seeing a positive movement in most of the major indexes. We see the Russell 2000 up almost 1%. We have the S&P 500 index up about 0.5%. And then also in the NASDAQ, we're up about 0.5%. The VIX right now is trading at 1356. So the VIX is actually up a smidge, about 1.5% on an up day in the NASDAQ and in the S&P 500 index. That just in general just shows a little bit of nervousness in the marketplace. And I think that's the best way to define what has happened so far in 2024. The marketplace, it wants to be bullish, but it is definitely nervous. And the Fed they've had some comments from a few of the generals at the Fed, and they're just kind of saying that, well, one of the biggest things that we're looking at as far as the economy is concerned is that wage growth is still very strong. And at this point in time, it's been noted that the wage growth is actually stronger than what is happening with inflation. So we're having wages growing faster than we are seeing inflation grow. A lot of concerns a little bit about that inflation might peek its little head back up again. But as I've mentioned many times on Options Guide TV, one of the biggest things is rate cuts. The CME Fed futures market and the Fed Watch tool is still saying that in March, there's about a 60% chance that the Fed will cut rates. And the market is pricing in a lot more cuts than what the Fed was even implying in their outlook over the last 6 months or so. So we're seeing that potential rate cut. We're seeing interest rates kind of, because of the news that we had last week, we see the 10-year just dancing right around that 4% level. So bullish but nervous. That's still the way that I think the market is. So on Friday's show, we decided, based off of the chart, to do a long straddle in the IWM. I'm not as excited as the last long straddle that we did about 4 months ago on Options Guide TV on the downside of IWM. But as far, which is the ETF that tracks the Russell 2000 index, I should probably make you aware of that because I can't just assume that everybody knows that. But we looked at buying an at-the-money call and at-the-money put. That means that we're at an inflection point as far as the chart is concerned. And I'm not too happy with the way the chart has opened up on Monday. As I said, the Russell is up about 0.8%. I'm going to run right now to the charts in the Russell 2000 index. So let's jump over to the IWM chart and show you what we were looking at here. So the last time that we did a straddle, we were down at the 165 level. So make sure we're showing it here. So we're down right at the 165 level, and obviously you had a strong movement to the upside. So if we broke down, the Russell got scary, and we came down to that level 1, 2, 3. This was almost down that level there. So that was the fourth time. So a breakdown would have been really scary in the IWM. We did not have it, had to bounce and had a real strong move to the upside. And this was actually kind of a fake out, right? We had we came all the way back, broke through this level for a minute, and now we came back down. Now I'm going to zoom in on the Russell 2000 index and show a couple of things. Well, first off, we got our ducks in a row. So that was a positive move in that they call this a golden cross. It matters a little bit more to me when we see the 50-day crossing over the 200-day. That's usually showing some strength in the market. And then you have the 200, the 50, and the 20, your ducks in a row. That's usually a good, what just means that you have a healthy marketplace. Now, when we came down to this level, I was really kind of hoping that that candle would fill that gap up that we had from, what's this range, 186 up to 194. We came and bounced on that level, and now we're kind of having an up day. So right now, if I look at the trade, we're down a little bit on it. I would have liked to see this candle kind of fall through and kind of fill this gap, but now then we'd be trending in the middle of that range, that huge range. So this was definitely a fake out. If we go back to those levels again, obviously every time you get close to those levels and can break through them, the better that you're going to have a better opportunity as far as charting is concerned, that we can have a strong move to the upside. So if I go back and look at our trade that we had on Friday, the screenshot that I took showed that we paid $6.37. The market was at 194.06. We see it at 194.90. We did the January 19th expiration of 2024. So we still have a good bit of time left. It looks like we got 11 days left. We need the market to move over the next few days. So by Wednesday or Thursday, if the market is still hanging in this area, we're going to think hard about just taking the trade off. $6.37 at $637 plus any commissions or fees that you may have paid for the 1x1 long straddle. If I get down around, I definitely don't want to lose that entire $600. So if we do get cut in half, and we're looking at about $300 position to get out of it, then I definitely want to take the trade off. We didn't get the volatility that we're hoping for, even though we had Boeing do its best to try to add some volatility to the marketplace. The market is strong, even though Boeing is not. Boeing's down about 8% today, based off of the news over the weekends with the issues with their planes. Okay, so looking for some volatility, but still thinking that the market is just going to stay in these doldrums. Today, I'm going to jump over and try to continue with my strategy in the SPX that we have done. We've done going most of the month of December. We were long the market, looked at a lot of long call spreads, and also some skip strike butterflies. So we usually would do the skip strike butterfly on a Friday. And if we were doing the long call spreads, we did them on Monday, and they were 1 week trades. The Monday trade would expire the very next Friday, and also the Friday trade would expire on that Friday. I think because another strategy, if I want to be bearish, and like I said, I'm not, as far as the market is concerned, well, we can run over. Let's look at the SPX chart real quick. Kind of boring. Right. We're right in this range. We're just getting some chop. 4,700, I think, is an interesting range. And now let's go out about 900 days here. Let me add some days so that we can see these candles over on this end of the chart. So right in this range, right around 4,700, I think is going to basically be a stopping point. We've already stopped there a couple of times. So now I'm going to zoom in on the market. And just kind of hanging around this area, right around, and this is also the 20-day moving average. We have that kind of giving a little bit of support in this area. So I'm going to be neutral to bearish this week. And a strategy that I've used a lot, and I do this with the long call spreads, is I put a long call spread on. If the market goes against it, we will sell a short spread and turn that into a butterfly, and I'll give you a chip and a chair. So you're not just closing out your trade, you're giving yourself a chance, and it's a 1 week trade. Usually make that adjustment on, hopefully by a Wednesday, the market will move against you, because then you can still you still got some premium in the S&P 500 index. I'm always doing it on a 1x2x1 basis or a 1 unit basis. You can always obviously multiply it by the number of contracts that you might want to do. And as always, this is not meant to be a recommendation. We're just looking at here on Options Guy TV. Biggest thing is to try to use as many strategies as possible based off of the market and try to show you how to implement a lot of the 40 different strategies that are in the options playbook. Now, with that mentioned, we do have a fig leaf portfolio, and we're going to look at a trade. We're going to add a trade to our portfolio that's inside our paper trading account over in the TradeHawk software. Okay, before I get on too much of a tangent, let's set up this trade this week. It is a Monday. It's a good day to put the trade on. I'm not doing a skip strike, so I didn't do that on Friday. We're going to do this in tandem with the Russell 2000 index trade. We'll definitely be out of that Russell 2000 index. It's probably on Wednesday's show, to be blunt, if the market keeps doing what it's doing. If we don't get some of that volatility that kind of was anticipating in the market, especially in the Russell index. Okay, so let's go back to the TradeHawk options grid. I'm going to type in SPX here. A little bit of sniffles. Come on, market. I froze up a little bit. Sometimes that does happen when I'm running the StreamYard software. So give it a second for it to catch up. And we're going to go down 20 points in the SPX. We're going to go from where the market is at, which is about 47.20. I think 4,700 is the line in the sand. So we're going to actually make that the midpoint inside our butterfly. And while I'm waiting for that to catch up, because I am still frozen on my option chains at this point in time, let's switch it up a little bit here. Let's jump over to the options playbook, and we'll pull that up real quick, and we'll just look at the long butterfly with puts inside the playbook. Kind of going on a tangent here, waiting for the software to catch up. So seasoned veterans inside the options playbook. This, if you do not know, this is the book that I've written. This is the companion website. Have a lot of new things that are coming. There's actually going to be a new website that's going to be coming out by the end of the month. Tradier is the main sponsor of the website, and we always thank them for that. So we have a lot of their banners within and special offers from Tradier. Run down here, long butterfly. Why am I not seeing it? Long butterfly with puts. Okay, so everything, all the butterflies that we have done so far have been on the call side of things. Mainly because we've been more bullish than bearish. That's a big reason why. But if I'm doing puts, we're going to be on the downside of the market. Now, ideally with butterflies, it doesn't really matter if you're using calls or puts. But if I'm going to trade them and I'm going to start a position, I'd rather be out of the money when I'm doing a directional and use puts. So since we're going to the downside and we're going to lean to the downside, we're going to use puts because the markets are tighter on out of the money option contracts as opposed to deeper in the money option contracts. So that's the whole rationale that's behind it. Not to mention we want to be bearish, so it makes sense to use puts. It just in my mind it makes a little bit more sense to me that we're going to do that. But the market's going to be somewhere around strike C. Right about here is where that market is in the SPX. And then we're going to sell 2 at strike B. That's going to be right around the 4,700 level. That line in the sand. We got 1 week. We got 5 trading days. Well, 4.5 now. And then we're hoping that it will stay between our strikes, between strike A and strike C. Obviously, we're going to pay a debit, but it's not going to be a large debit, mainly because we're doing the butterfly. And that's one of the big benefits of that butterfly is that you can put it on inexpensively. You have limited and known risk. And we also have an adjustment. If we need to move this trade, we can adjust it if the market goes against us, and we would roll into a short put spread at that instance. And we'd kind of flip our diagnosis as to what we want to happen in the S&P 500 index over the week. Okay, so let's jump back. Let's take quick peek here. 1 second, and see if we are getting our quotes back. All right, there we are. Okay, let's jump back here. And if you have any questions at all, Options Guy TV, we're doing this live. And as you can see, we're using live markets. So we're dealing with live market data. So if you have any questions and you want to talk about either the long straddle or butterflies or just one-off topics on option trading, please put them in the chat box. I'm happy to try to address them during the show. Like to make this as interactive as possible. All right, so 47.20, that's where the market is at. 47.19, actually it was up a little bit, so maybe our butterfly's actually going to move just a tad. We're going to pay a little bit more than I had hoped for that butterfly. So here we go. That's our long straddle. Let's clear that out. We're going to be buying the 720 strike put. Expiration, we want to do the 12th, which is the 4th right here. Okay. 12.4. All right. 720. Clear this out. We're going to be buying that. This is our line in the sand. This is the market that we want it to come down. We're on this side of the chains, which means that we're talking about puts. We're going to sell 2 of these. So I click on it twice. It adds them both. I love how simple the order entry is on the Trade Hawk options grid. And then the 46.80s, we're going to buy 1 more. This is going to be our protection. Yeah, so that's up a tad. It was about 170 when I was looking at it before the show. So now we're going to pay a little bit more. So it's $2, but we have a 20-point wide spread. Maximum it could trade for is $20, which is the width between the strikes. And we're not looking to try to make that maximum. And that's one of the things to learn about butterfly trading. If I put it on for $2 and I can get out for $4, that's obviously a wonderful trade. And that would be a goal of mine. Even if I make $1 on the trade and I'm managing my risk and looking the same way, I'm still doing very well. But in this instance, we have a huge rate of time decay. If we even just get a couple of days worth of time decay and the market just hangs right where it's at, right at that 47.20 level, we should be profitable on this trade. That also means that if we hold it all the way to expiration, we need the market to go down by at least $2. So 47.18 on this end of our butterfly is where our break-even point would be at expiration. And on the other side, if the market went all the way through our strike and we did not get out, which we'd get the stupid award for that, market would be at 46.82. That would be our break even on the other end of our butterfly, on the other wing of our butterfly. So if I take a quick peek at the what if calculator, I've already taken this trade and put that in there. Here's what I was talking about. Inside the options playbook, we have the market trading right here at 47.20. We're going to pay $2 for our trade. If the market lands, so to start with, there's not going to be the green line is showing our profit and loss graph as of today. So we don't have a ton of risk if the market goes against us. We can still have time to adjust. And if the market goes with us, it's not going to reward us a lot. But every single day that goes by, this green line, our profit and loss graph, is going to morph into the P&L at expiration. So dramatic time decay can happen. Implied volatility comes down. That could also help us. We want the 2 at-the-money option contracts to wither away. We need as much time as much time value to come out of these 2 options if we're correct on our forecast. If we're not correct, well, we got some time to adjust. And what we would end up doing is rolling this into a short put spread. And so if the market does continue on up, we'll talk about that trade on Wednesday's show. All right. So got a few more minutes here, and I want to talk about one position that I want to put on. So inside our paper trading account, if you have any questions on that, please put them in the chat box. But let's run back out to the main screen, and we'll talk a little bit about our paper trading account. So we have, and I can't go to it because one of the things inside the paper trading account, I cannot get quotes on indexes. So I'm just going to talk about the trade and we're going to put it on, and I'll go into the paper trading account after the show and I'll actually execute this trade. but we are long a call option in Eli Lilly. It had fairly decent news, but it's not really affecting the bottom line. It's about the potential in Lilly, but they're going direct to consumer. And they're talking about a lot of the weight loss drugs, which are really diabetes drugs, and some of the success with them, bypassing a lot of the pharmacies, going direct to consumer with it. Concept is that it'll be easier to get the prescriptions. Not really sure how that's all going to work out, but Eli Lilly, it was a positive move for the market. So if I type in Lilly and you look at this, it had a real strong move to the upside, and we're giving a little bit of it back. As a matter of fact, the chart is interesting in that we're looking at all-time highs in Eli Lilly, and we're at right at that 64. What is that? 631. We'll call it 632. Let's call it 632. Right about 632. Looking to try to break out to the upside, and it failed. And so, if I zoom in on this area of the chart, you're seeing we're really struggling. There's a little bit better view on it. 630, right at that level, and we couldn't quite break out of that level. Now, obviously, these are some thin candles. We didn't have a lot of volume there. 620 is this range, and this is where we're hanging. So I think now is a good time to actually sell a call against this position, and that's what we're going to do. So we have a deep in the money option contract that's acting as a surrogate for the stock inside our paper trading portfolio, inside the TradeHawk software. So we're going to pull up Lilly. We're going to try to do something short term out of the money. We still got some juice in these option contracts. We're looking at the volatility right around 30%. And we're going to go out to the January 19th, because we can get enough juice, because it's a $600 stock trading at a 30% volatility, that we can sell something not that far out of the money that will give us some premium. And that's kind of our goal here. So we're looking at the 640 level. Well, one standard deviation move is right between 640 and 645. We kind of confirm that by looking at the delta. We got a 15 delta on the 645 strike. Delta should be right around 16 to be the one standard deviation move. The TradeHawk options grid will highlight where the one standard deviation move is based off of the strikes. So I'm going to actually go up a little further than that. We're going to sell the 655 strike, and this will be the paper trade that we're going to add to our portfolio. We're going to bring in some premium, 655. We're going to hit the bid on that. So looking at about market extrinsic 123. Okay, the midpoint is 123, 115. We'll probably look at 120. We're going to put it in the paper trading portfolio at $1.20. We have one deep in the money call option. If we get a little bit of a pullback, we'll add some more deep in the money calls. If not, we're going to start selling calls against that position. We're going to fill up our paper trading portfolio. We got $100,000 that we want to get into the marketplace, and that's our goal over the next month, to try to fill that to spend all those monies in about 5 or 6 different deep in the money positions. We'll focus a little bit on that on Wednesday. But based off of the news on Lilly, I think it was time to sell that call position, especially with the fact that we couldn't break out to the upside. So that's going to be the second paper trade for Options Guide TV. So we got a lot going on this week. We're long a straddle and a Russell. We are bearish but nervous, a little bit bearish in the S&P 500 index, and we're addressing that with a long put butterfly spread. And then we're still managing our longer term portfolio by selling a call in one of the stocks that we own, which is Eli Lilly. All right. And with that said, I do not see any questions in the chat box. This will be it for Options Guide TV today. We'll be back on Wednesday at 11 a.m. Eastern time for the next edition of Options Guide TV. Thanks for coming, everyone.